This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Scott Norse here with today's Forex report. It is Friday, April 6, 2007. It was a trying week for the U.S. dollar as traders continued to find reasons to sell early on. We kicked things off Monday morning with another drop in ISM manufacturing, bringing the index dangerously close to 50, which is the line in the sand between expansion and contraction. Of course, with the services sector making up a much greater percentage of GDP, traders were still hoping that a rise in non-manufacturing ISM would ease fears of a possible recession. This report came out Wednesday morning, and it too disappointed the market by falling 2 points to 52.4. However, things turned much brighter for the greenback today when the March employment report surprised traders with two great numbers. The Bureau of Labor Statistics said this morning that the U.S. added 180,000 jobs last month, and the unemployment rate fell to 4.4%, the lowest since 2001. While this did not allow the dollar to recover fully against all currencies for the week, it certainly gives the U.S. currency a fighting chance next week. In other news this week, traders found great disappointment in the decisions from both the RBA and BOE to leave rates unchanged. The pound sterling and Aussie dollar are among the highest yielding major currencies, and both underlying economies had offered data recently that suggests rate increases are needed. However, traders may be a little less aggressive in buying these currencies until they are certain the banks will move in upcoming meetings. The euro and franc were among this week's strongest currencies as the ECB and SNB are expected to hike rates this year, and Germany continues to boast strong data in the face of higher taxes. The Canadian dollar is also showing some new signs of strength as data from that economy continues to impress. Canada reported its March employment report yesterday, which included a 6.1% unemployment rate and the addition of 54,900 jobs, 5 times more than expected. The yen was the weakest currency among the majors, as data remains mediocre and traders see no reason that the BOJ will hike rates again anytime soon. Now to the big picture. Amid a batch of mixed U.S. data, the International Monetary Fund this week released some comments that will be included in its semi-annual report that will be published next Wednesday. In the report, the IMF noted that the slowdown in the U.S. economy did appear to be contained to housing and manufacturing. It added that because the slowdown was contained and moderate, it had little discernible effect on growth in most other countries. The fund estimates that the world GDP will increase 4.9% this year. While this bodes well for the health of the U.S. and many other major economies, the report also said that a deeper slump in the U.S. could send shockwaves through the global economy, especially if it leads to a sell-off in financial markets. Last but not least, the IMF again pointed out that a slide of 10% in the value of the U.S. dollar would help greatly in reducing deficits. Well, this is certainly not news to anyone. Reiteration from the IMF could be enough to get traders focused on the U.S. structural problems and give them yet another reason to unload the greenback. The U.S. currency has already come under great pressure in recent weeks, yesterday reaching a new 2-year low versus the euro. The big picture only appears to be growing darker, and we believe there is room for further weakness ahead. Till next week, have a great weekend and take care.